Why boring investments often win. Have you noticed something strange? The investments that dominate headlines, the ones everyone is rushing to buy, rarely create lasting wealth for the average person. Meanwhile, the investments that seem almost boring quietly build fortunes. That isn't a coincidence, it's psychology. Imagine two friends, David and Michael. Every morning, David checks the stock market before he even gets out of bed. He's chasing the next hot stock, reacting to every news headline, and trying to predict where the market will go next. Michael, on the other hand, invests automatically into a low-cost index fund every month and then goes about his life. No excitement, no drama, just consistency. Fast forward 20 years. Surprisingly, it's often Michael who ends up wealthier. Why? Because investing isn't just a numbers game, it's a psychology game. Our brains are wired to seek excitement. Every market rally triggers dopamine, the same chemical that rewards novelty and anticipation. We fear missing out when everyone seems to be making money on the latest trend. We convince ourselves that doing something always feels better than doing nothing. Psychologists call this action bias. But in investing, more action frequently means more mistakes. Here's the truth many people don't want to hear. The stock market doesn't reward entertainment. It rewards patience. Think about investors like Warren Buffett. His philosophy has never been about finding excitement. It's about buying quality businesses, staying invested, and allowing time to do the heavy lifting. That's why concepts like long-term investing, data cost averaging, broad market index funds, and compounding have stood the test of time. They aren't flashy, but they work because they remove emotion from the process. One of my favorite investing reminders is this: your portfolio doesn't need to entertain you, it needs to grow. Another is, excitement is expensive in investing. And perhaps the most important, the market rewards patience far more often than prediction. Does this mean you should never take calculated risks? Of course not. But if your financial future depends on guessing tomorrow's market movement, you're playing a difficult game against professionals, algorithms, and millions of other investors. Instead, focus on what you can control. Invest consistently, ignore the daily noise, let compound growth work quietly in the background. Think in decades instead of days. Ironically, the most successful investing journey often feels uneventful. There are no dramatic victories to post on social media, no constant adrenaline rush, just steady progress that compounds year after year until one day people call you lucky. If this changed the way you think about investing, I'd love to hear your thoughts. Have you ever chased an exciting investment that didn't live up to the hype? Share your experience in the comments. And if you enjoy learning about the psychology behind smarter investing, don't forget to like this video, subscribe, and join me for the next conversation. Sometimes the quietest strategies make the loudest difference.